Hello, I'm Lucas Guilfoil.
I'm Carter Hall.
I'm Abby Harrington.
I'm Brooke Hanson.
And I'm Luanne Hale, and we're Common Stock.
The Common Stock Group here at the University of Kansas in Accounting 205 has gone through the financial statements regarding Nike Incorporated, one of the most favorite places among students, professors, and just individuals around the city here in Lawrence. And, where you can get your shoes, your clothes, and our hat here, as one of our fellow classmates has. Here are the following numbers regarding those financial statements. Through our research, we have found that current assets as of May 31st, 2014 are at $13,696,000,000. Accounts receivable have reached upwards of $3.1 billion in 2013, while increasing all the way up to $3.4 billion. Intangible assets for 2014 were at approximately $282 million. While looking at current liabilities, accounts payable were found to be $1.6 billion and increasing upwards to $1.9 billion in 2013. On the other hand, accrued liabilities soared from $2 billion on up to $2.4 billion by Nike paying more dividends. Long-term debt in 2014 was an approximate amount of $1.2 billion. Lastly, for the year 2014, stockholders' equity was at $10.8 billion, while total stockholders' equity was an enormous $18.6 billion, giving Nike Incorporated retained earnings of $4.8 billion. Retained earnings are defined as the cumulative amount of the reporting entity's undisturbed earnings or deficits.
An example of a company's accounting policies is allowance for uncollectible accounts receivable. Accounts receivable consists primarily of amounts receivable from customers. The company makes ongoing estimates relating to the collectability of its accounts receivable and maintains an allowance for estimated losses resulting from the inability of its customers to make required payments. In determining the amount of the allowance, the company considers historical levels of credit losses and makes judgments about the creditworthiness of significant customers based on ongoing credit evaluations. Accounts receivable with anticipated collection dates greater than 12 months from the balance sheet date and related allowances are considered non-current and recorded in deferred income taxes and other assets. The allowance for uncollectible accounts receivable was $78 million and $104 million at May 31st, 2014 and 2013, respectively, of which $37 million and $54 million respectively was classified as long-term and recorded in deferred income taxes and other assets.
Another example of Nike's accounting policies is income taxes. The company accounts for income taxes using the asset and liability method. This approach requires the recognition of deferred tax assets and liabilities for the expected future tax consequences of temporary differences between the carrying amounts and the tax basis of assets and liabilities. The company records a valuation allowance to reduce deferred tax assets to the amount management believes is more likely to not be realized. United States income taxes are provided currently on financial statements earnings of non-U.S. subsidiaries that are expected to be repatriated. The company determines annually the amount of undistributed non-U.S. earnings to invest indefinitely in its non-U.S. operations. The company recognizes a tax benefit from uncertain tax positions in the financial statements only when it is more likely than not that the position will be sustained upon examination by relevant tax authorities. The company recognizes interest and penalties related to income tax matters and income expense.
Note 2 from Nike's financial statement is inventory. The inventory has a balance of $3,947,000,000 and $3,484,000,000 at May 31st, 2014 and 2013. Respectively, were substantially all finished goods.
Note 4 of Nike's financial statement is identifiable intangible assets and goodwill. Goodwill was $131 million at May 31st, 2014 and May 31st, 2013. $64 million included in the Converse segment, and the remaining amounts are included in the global brand divisions for segment reporting purposes. There were no accumulated impairment balances for goodwill as of either period end.
That's Nike Incorporated here at the University of Kansas. For Common Stock, at Counting 205, we're signing out.
Lace 'em up, lace 'em up, lace 'em up, lace 'em. Blue suede shoes stay crispy like bacon. Nikes on my feet make my cipher complete.